Hello everybody, welcome back to Steamboat Real Estate and Investing, your inside track to real estate, mountain living, and intelligent investing here in Steamboat Springs, Colorado with me, your host, Ryan Cox. As you can see, fall is in full effect and the leaves are beautiful. If you're not here, try to get up here. The colors are the best they've been in years. Today's topic is one that's been in the headlines and on everyone's mind: mortgage rates. Over the past few years, rates have been on a roller coaster, shaping what buyers can afford, influencing how sellers approach the market, and ultimately determining how deals come together here in Steamboat. To help us make sense of it all, I'm joined by Chris Magnotta, branch manager at Elevate Home Loans. Chris holds a master's degree in business and finance and brings years of hands-on experience guiding buyers through these shifting conditions. Together, we'll unpack where rates have been, where they're growing, and what it means for buyers, sellers, and investors in the Steamboat market today. Let's get straight into the podcast. All right, welcome back everybody to Steamboat Real Estate and Investing. Today, I am joined by Chris Magnotta with Elevate Home Loans. How are you, Chris?
Phenomenal.
Awesome.
It's a beautiful day in Steamboat.
Beautiful
Fall
day.
is gorgeous.
No doubt, no doubt. Well, Chris, tell us a little bit about what you do, what Elevate does,
For sure.
what makes you guys unique. Give us a little overview.
For sure. So I work in residential lending. So primary job is to help people buy the dream here in Steamboat. So we're the top lender here locally, and I have a great job because basically I get to finance people's dreams, and it's a lot of fun. So all residential stuff, but a lot of primary homes, which is fun, but also a lot of vacation investments as well. So just helping people buy homes is what I do.
Awesome.
Yeah.
Do you guys primarily operate in Steamboat proper or all over Routt County? Where geographically, where do you guys operate?
I would say probably about 70% of what I do is in Routt County, kind of all over Routt County, because generally our business tends to come from real estate agent referrals. And so I just work wherever my real estate agents have me working. And I do a little bit of stuff on the Front Range, as well as a little bit of stuff in Grand Junction and other mountain towns as well. But it's predominantly Routt County, all over the place.
Nice.
Yeah.
Nice. Okay. Well, where are rates now? We've seen a lot of headlines recently, and a whole lot to unpack there. But give us the 10,000-foot view right out of the gates.
Yeah, the 10,000-foot flyover is rates are up a little bit from where they were in the beginning of September. So beginning of September, they kind of hit a low right around 6.1%. That's the national average, 20% down with good credit. But so we've seen them tick up roughly 0.25% in the last couple weeks, kind of following the Fed rate cut and stuff. But we're pretty positive about where we are now, at least compared to where we were 3-4 months ago when we were up over 7%. So it's pretty nice to be at least sub 6.5. I think that loosens up the market a fair bit. But right now technically we're at 6.37 to be exact. Okay. That's the national average, 20% down in good credit.
Chris puts out great videos weekly. I think your video last week, you were doing your market report from the mountain bike, which is great. I'm gonna have to do that at some point. Get out of the office studio. But you made an interesting comment. Obviously, we had a big announcement from the Fed, 1/4 point reduction, but rates went up.
Yeah.
After that.
Yeah.
How does that work?
Yeah, it definitely caught a lot of people off guard. And I actually was talking about this for a long time. I'm like, I had about 10 people who were going under contract and like, hey, should I wait until after the Fed cuts rates? I'm like, no, don't do it. And like, why? It doesn't make sense. They're cutting rates. But the big reason is because the Fed rate cut is Fed funds rates, which is a really kind of short-term interest rate. So mortgages are long-term. So it's kind of just a whole different market dynamic for long-term stuff. And when I look back at last year, this was my big warning to people. Like, the Fed Reserve cut rates in September of 2024, and we saw interest rates basically go from 6.1 all the way up to 7.1 by the end of the year. Yeah. So just kind of shows you how mortgages can, in fact, go in opposite directions. And it's because it's just more of a market dynamic with the mortgage rates. While the Fed has cut lower interest rates, they haven't done anything positive for long-term rates.
Yeah.
So they're still restrictive is what they call it.
So if people want to follow an asset class or understand where mortgage rates are headed, what are they watching?
Yeah, I mean, the the asset that has the highest correlation with mortgages is going to be your 10-year Treasury bond. Yeah. So we've been seeing that kind of the day the Fed cut rates, it went just below 4%. It was like 3.99 or something like that for an hour. But then it went back up over 4%. And I think today it's in the 4.1, 4.2 range. So, kind of that's been the closest asset that we have that tracks mortgages.
Okay.
One of the positive, actually, stories, though, this year has been what's called the spread between the 10-year Treasury and mortgages. So generally speaking, you could take the 10-year Treasury and you add 1.75% and you would have the mortgage rates.
Okay.
That's kind of the historical average. Last year, it was like really high, and the year before even higher. So it would get like 2 to 3% higher. And so we call that the spread. And that spread has been shrinking. And so that's actually one of the main reasons that mortgage rates are so much better this year than they were last year, even with the 10-year Treasury not being in that much different of a spot. We have those spreads are shrinking. So that's really been one of the more positive stories that people aren't talking about this year.
Okay.
Yeah.
And I know we could dive way deep, way
we
deep.
Could go deep.
But what influences the spread?
So the spread is about kind of lenders trying to predict the future.
Yeah.
So
hedging.
Yeah. So the lenders feel that the long-term projection for interest rates is going down. And because of that, they're trying to beat the market to it.
Yes.
And so what they don't want, what lenders don't want to happen is to issue an interest rate and then interest rates go down and everyone refinances it. Because a lender, to make money, they have to have the loan for about a year at least. Or they don't, because a lot of the closing costs are not passed on to a buyer. So when a lender closes on a loan, they're actually in the hole, somewhere between $5,000 and $10,000. And so if someone refinances that loan 5 months later, lenders lose a lot of money. So lenders trying to anticipate the direction of the market, and that's part of how we've seen the mortgage spreads go down.
So how far ahead of the Fed rate cuts are the lenders with the shrinking of the spread? They're trying to get ahead of it. How far ahead of it are they? And do further Fed cuts move the needle?
With mortgages, further rate cuts probably don't move the needle, but lenders, they go in real time. So they're already anticipating the next 1 to 2 actions from the Federal Reserve. So kind of with rate cuts, what lenders are more banking on right now is that the Fed changes other policy. And so what I mean by that, great way to think back of 2020, 2021, right? Remember all those 2%, 3% loans? Well, that was because the Federal Reserve artificially manipulated the market, and they did that by buying treasuries, buying mortgage-backed securities. So it was a fake interest rate. It was artificial.
Yeah.
Shouldn't have been so low. Well, right now, the Fed is doing the opposite of that. They're artificially making them high. They call it restrictive policy or balance sheet runoff. There's a lot of different lingo people around it, but I like to simplify it and say the Federal Reserve is artificially making interest rates high right now. And the hope is that lenders, that with these rate cuts, will also coincide with changing that policy. Because right now, their policy is just very restrictive. And mortgage rates, about 70% of what drives it, and the 10-year Treasury, about 70% of what drives that is Federal Reserve policy.
Okay.
So we just haven't, while we've seen the rate cuts on the short end, the short-term interest rates, we haven't seen any changes to the policy that would impact the long end, and so that's why we just aren't seeing those
big movements.
That's why we're not seeing that stuff.
So if they've already anticipated the next 1 to 2 moves, I mean, of course, everybody's got their theory, but sounds like 2 additional quarter point reductions is maybe a reasonable assumption? Is that a reasonable
for sure.
assumption?
And that's what the market's pricing in right now. They're definitely pricing in, a couple more rate cuts for sure, and then another 1 or 2 next year. So the market's pretty well pricing that in right now, but the Federal Reserve's not making it easy right now because you have some Fed members who are like, no, stand strong, labor market is fine, and then you have other Fed members who are like, we should have cut rates a long time ago, and so there's definitely some disagreement within the Fed governors right now, and it's making it a little trickier on people trying to guess which direction the Fed's going.
And there's, of course, a lot of external pressure from Trump, which is ruling the headlines, so that's another element. So if they've already anticipated, say, 2 more quarter point reductions in between now and the end of the year, I mean, I'm fast forwarding to the end of what I thought where our conversation would go, but is your prediction that rates largely stay flat?
I think so. I think there'll be a lot of volatility for sure.
Okay.
Particularly, this time of year, September, October tends to be pretty volatile anyway, both in the stock market and in the bond market. Mm-hmm. We see a lot of volatility. So I would expect some volatility. I don't think interest rates have a lot more room to go down, at least below 6%. They can probably go down, maybe where they were mid-September, around that 6%, 6.1. I think that's reasonable, but I think to go below that 6%, we'll need some kind of change in the Federal Reserve policy for it to happen, and some kind of weakness in the job market. I think the number one thing that can get mortgage interest rates low is weakness in the job market. And so when we saw the mortgages drop down the beginning of September, it was because of soft labor reports. That's the primary reason.
Well, we had that massive revision, right?
Yeah, exactly. The economy didn't really create all these jobs that the BLS had said, right?
Yeah.
Oops, we were off by how many?
What was it? 900,000 or a million jobs?
Yeah, it was crazy amount.
It's significant.
Amazing. You got the largest economy in the world, making and the largest entity in the world, in the Federal Reserve, making its decisions based upon bad data.
Erroneous.
It's kind of shocking.
Data. Shocking, concerning. I heard you on your Friday report. I heard you say that you locked somebody in at 5.99%.
Yep.
You were able to dip down below that 6% threshold.
Yep.
What was that loan, and how were you able to make that happen?
Yeah, that was a local primary homeowner who was buying in Stagecoach, I believe, somewhere close to Oak Creek. And so, what they did was they paid down points just a little bit. I think they paid 1.5% up front. So if it was a $500,000 loan, kind of guessing on that, somewhere in that range, they paid $7,500 to buy that interest rate down to the 5.9 to get that there.
And over the 30-year lifespan of that loan, that would have saved them ballpark how much?
Oh yeah, I mean over 30 years, I'm sure it would have been probably like $40,000. It'd been a ton of money.
Yeah. So if you're in buying for the midterm, it's kind of a no-brainer. To buy down points.
Yeah, for sure. Because I think a couple ideas of buying down points are obviously it gets you that lower interest rate, but also it gives you potential. I guess you're reducing the amount of necessity to refinance it down the road as well. So sometimes people are like, well, I'm spending more up front, but maybe I'm saving $4,000 by not having to refinance, when rates go down. So now technically, like if interest rates went way down and they went to 5% or 4.99 or something, then they're still going to refinance.
Sure.
And if they did that within a shorter period of time, the cost, it would have been borderline, right? It would justify it. Okay. So I think, in some cases, there's definitely, you could pay the points, and if interest rates did drop way down, you wouldn't have won. But it's no one has that crystal ball, so it's kind of hard.
It's a gamble.
It's still a gamble. It's always a little bit of a gamble, right? If interest rates stay the same or go up, then obviously they're really winning.
Yeah. So refinancing, I read some data. I think maybe it was Land Title's report. The last 2 months, they've seen like 65 refinances or something. Yeah. Are you seeing a pickup in refinancing?
Oh, yeah. We've been really busy with that, especially where we're seeing the most refinances, people who have the bigger loans, because closing costs, honestly, are roughly the same, whether it's a $300,000 loan or a $1.5 million. It's like almost the same. Okay. But obviously, you get way more savings out of $1.5 million. Than you do out of a 300. So it's much easier to have those savings, cover the closing costs. I like to see that their savings cover the closing costs in 6 months or less. Okay. So if it's $3,000 in closing costs, I'm like, okay, well, that's great. I want to make sure you're saving $600 a month, so that way you're paying that off and paying off those costs in 6 months. So that's my kind of rule of thumb that I use to get people in. But a lot of people are refinancing because, some people, remember, there was not that long ago, I guess it was a year and a half ago maybe, that interest rates were 8%, right? Yeah. So I have clients that have, 8%, 8.1, and so when they're seeing, stuff in the low sixes,
that's a big spread.
It's a big spread. Yeah, they can be saving a lot of money. So
definitely. So somebody who's at a 6.5% 30-year fix, they locked in, whatever, rewind however long ago that would have been that they locked in, and rates were there 14 months, 16 months, I don't know.
Yeah.
What's your guidance? Hang on, wait, maybe next year?
I'd hang on. Yeah, usually if they're in the mid sixes now, I mean, you can get a little bit better interest rate for sure. But yeah, and especially with, the Federal Reserve likely making some big changes in the next, 6 months to a year, right? Because, well, we have a whole new Fed governor coming in. Fed chairman, because in May we have turnover there. So our current guy, Mr. Powell, he is out in May. So we have, you mentioned Trump. Well, he'll probably put someone in who's a lot more interest rate friendly, right?
Sure.
So, that could be one of the catalysts that changes some of that monetary policy that, like I was saying, the artificially higher mortgage rates maybe can get a little bit more neutral there. I think that's the goal.
Okay.
In which case, then you could definitely see stuff below 6% pretty. If that policy changes, like it would get below 6% pretty easily, I think.
Yeah. Now the days of the 2-3%, those are gone.
Those are gone. I always loved it. I mean, I was so popular back then. Everyone loved me. Now they don't love me as much as they loved me before.
Right. Conversations aren't as exciting or friendly. I mean, those days probably never come back.
I mean, it's hard to say never, but it seems unlikely. I mean, we would need some kind of major catastrophic job loss situation like we had in COVID for that to happen again. Yeah. That was purely a ton of money being pumped into mortgage-backed securities and treasuries and to make that happen. And it just seems unlikely that would happen without some kind of comparable event.
Sure, some outlier event.
And even then, it may not go as big because I think some of the lessons learned from that was like they had the interest rates too low for too long, and that's what caused our inflation, right? So, if they had maybe not gone as deep for as long, we wouldn't have had some of the inflation aftermath that we had.
The $10 for a dozen eggs scenario.
Yeah, a little too much for too long there.
Yeah. What we're seeing in the real estate market, obviously we've seen substantial softening over the last, really 4 months in particular, I'd say, coming into late spring, summer.
Yeah.
Lots of inventory.
Yeah. How many homes are in the market now? Right? 400 some?
Sounds,
400 some, right. I think,
Yeah, I'll follow this up with the exact stat as of September.
Yeah.
But I think in the past few months, we've been up 50% and change in inventory. And obviously that's on the heels of some really low inventory years.
Right.
But couple that with buyers who I think are pretty patient.
Yeah.
And, really watching rates. The market's it's stale.
Right.
It's a bit stagnant. I think we're down, 1% ish on sales volume and transaction count. How much of that do you attribute to rates?
I would say a lot, to be honest. Yeah, I think, if you look when interest rates really started to climb, I guess it's been a few, almost 3 calendar years now. But, that was kind of a progression. That inventory growth was kind of a progression during that time. I think we have a couple things that have really pushed inventory up. A lot of it, yes, absolutely, interest rates. Interest rates going up squishes demand. So anytime you have elevated interest rates, you're just going to have less home buyers. A lot of supply and the demand right there. And so not that many more listings were coming on than normal, but they just weren't being eaten up and going under contract.
Lower absorption.
Because of the lower absorption, because of the lower demand, because of the higher interest rates. And even more recent example would be like the last few weeks when interest rates have gone down. We have seen a lot more pendings come on.
Yes.
And and it hasn't even been very long. And usually people don't instantly make a decision to buy a house. Usually it's a process of a few months, right? I mean, there's certainly people who come here and like, I see the leaves, I got to buy. But more often than not, it's kind of planned for a while. And so I think that's really good news for bringing the demand back, because I think we can just have some lower interest rates, just even for 2 or 3 months in a row.
Yeah.
Like we'll see a really good spike in demand. So yeah, I think especially if the interest rates could get below 6%, it would be really good. I think it's a much more healthy market situation, because even though, like to your point, like inventory's up a lot, year over year or even over the last 4 months, but we're still like not that far off of average.
Yeah.
And so we got to have inventory to have a healthy market. So the supply side of things is getting healthy. The demand side still has some work to do.
Yeah.
And that lower interest rates will help that along.
It's interesting you say the 6%. I've heard that from different podcasts and reading, and that's why your statement of getting somebody in at 599 really stuck with me.
Yeah.
And I agree with what you're saying. The last few weeks have seemed to things have seemed to shift, and I just pulled the report yesterday, and we're seeing now, for lack of a better word, a real dip in or nosedive in new listings, and pendings are going the other way. I think we're going to see that absorption click back up and normalize there a little bit.
Yeah, especially too with our seasonal decline, right? Because we're right on the heels.
Yes.
Or I'm sure it started now, actually. Hindsight will tell us in a month or two when we look at the data. But my guess is we're going to have a big drop in inventory. Yes. Probably most years it goes at half, roughly, right? So I would expect if we are at 400 and some change now to be more in the mid 200s or low 200s by December, January, somewhere in there. So I would expect a big drop.
Yep.
And that will help the absorption rate as well, because if you have a lot less homes out there, and if interest rates can stay stable and keep the buyers there, then that'll move things along.
What are you seeing the loans that you are closing and the buyers that you're working with? What are you seeing them do? Are they asking sellers to provide a credit for a buy down in points? Mm-hmm. Are sellers already beating them to that punch? What do you see as the levers for both buyers and sellers to pull in this still above 6% environment?
Yeah, definitely. I would say a year ago, like the idea of a seller paying a buy down would be
unheard of
for
sure. 1 year ago, absolutely.
But to see that happening is actually really good. It shows a little bit more signs of a balanced market.
Yes.
It should be happening some. Yeah. It shouldn't be like on all the occasions. It shouldn't be on all the homes, and it shouldn't be on none. It should be somewhere in the middle. And we're starting to see that. So I think that we do have. I would say right now it's still being led more by the buyer than by the seller. I do have a lot of agents who are reaching out and like, hey, give me some ideas to move these properties. And so, there are chances like, okay, maybe if the buyer, could get the interest rate down to 5.375 for 10 years. That's one example, is like 10-year loans at 5.375, in which the seller would pay, roughly 1 to 2% of discount points up front. So if you had $1 million loan, maybe you're paying 10, 20 grand to buy down the interest rate for the buyer down to like I said, somewhere in that 5.3, 5.5 range. So we're seeing a lot of that on the higher price points. The lower price points, the 2-1 buy downs are very popular, which would be like, it's a progression. So like year one might be like 4.125, and year two might be 5.125, and then year 3 and beyond might be like 6.125.
Okay.
And so those type of buy downs have become really popular, but those are more for the lower purchase prices. The reason why is the max conventional loans a little over 800 grand right now, and they work on conventional loans, not on some of the big loans that are like $1 million or 1.5.
Yeah, and I mean, if you can secure a deal structure like that, a rate like that, that gives you runway to maybe get to next May when we have new head of the Fed, new policy coming in, and then you could look at refinancing, restructuring at that point to lock in your longer term rate.
Yeah, for sure. And I think that's definitely the mindset for a lot of those buy downs is like, okay, if I can just make it a couple years with these, I can get 4.1 now and 5.1, and then by the time it gets to 6.1, hopefully I've already refinanced and I never have to go there.
Yeah,
and I think that's definitely the mindset for a lot of them.
Nice. We've covered a lot of good stuff. What else? What questions or topics have we not hit on that you think the listeners might be interested in? Rates and lending.
Yeah, gosh, so much going on right now. So much going on. I think. I'm just I think overall excited that we do have some potential major changes over the Federal Reserve in the next bit of time.
Yeah.
And I think the housing outlook is probably as positive right now as it's been in a long time, because, the lower interest rate environment, should bring that demand back. We're already having more supply. And so I think that the story right now that's coming out of housing, really has a positive outlook. I think sometimes people look at inventory the wrong way. They look at it as a bad thing.
Sure.
But if you're a home buyer, this is like I've had a lot of buyers who've been waiting, like, oh, Chris, I've been looking and looking and looking, and just the right stuff isn't coming up. And looking. I hear those stories all the time, and now they're have an opportunity to like, hey, I can find a property that fits my needs. So I think that's a really positive side that isn't getting a lot of light right now.
Yeah. As you said, I mean, you have to have inventory to have a balanced and active market. So I totally agree, especially couple that with the seasonality, and I think you're right, that absorption is going to tick up, and months of supply is going to ratchet down. And, but still, buyers will have some options out there, and more leverage than they've had in 5 years, 6 years.
To see opportunities for these, seller concessions and buy downs and stuff is a really good thing, and to see price cuts is a really good thing. We need to have price cuts to have a balanced and healthy market. And when we had the super low inventory, 2, 3, 4 years ago, it was unhealthy for sure. And sellers just had all the power, which is great if you're a seller, but
sure. We talked a little bit about your outlook, but what do you think 2026 holds for the steamboat market?
Yeah, great question. So very rate dependent for sure. I would expect the climate inventory to start to stabilize. So I wouldn't expect the kind of continued inventory climb next year like we've seen this year. And I think I think we'll look back and be like, okay, that September, October of 2025 was a little peak. But if the interest rates stay low, we'll have the demand to make that happen for sure. So I guess overall I feel like different product types could be difficult, particularly some of the sellers who are buying in certain condo projects that have had negative stuff happen with the HOAs. Those are going to be tricky. Those are going to be hard spots. But, to find a good single family home under $2 million right now is it's still you want to talk about inventory limited, a good home under $2 million in town is still extremely scarce. And so I think there's going to be certain segments of the market that are still extremely strong. And then we'll see some challenges in other areas of the market where we have some excess inventory coming on, especially with some of the HOA dues climbing up on people.
Yeah, I think you're spot on there. It's just the condo inventory seems to be, not a glut, but there's a lot of product there, and the carry costs are significant with the HOA dues and, of course, the recent reassessments. Look at that, plus the HOA dues, which are spiking, largely due to insurance, right?
We've seen some extreme moves in insurance for sure. Extreme, double, triple, or more insurance premiums jumping.
So I completely agree with you. Well, great information. So the last question I like to ask is if you had $1 million to invest in Steamboat Real Estate or business, what would you invest in and why?
So I like to invest in kind of the tried and true, which are, if you look back at investments over the long run, the best performing classes are real estate and the stock market. So I really like, I would put half of it into real estate. I like a good balance between real estates and stocks. So I'd be putting half of it into real estate, and I'd put basically the other half into the S&P 500. It always gets 10 to 12% on average, and I don't expect that to change. So the old tried and true S&P 500 index fund and real estate, half and half.
Boom. All right, that's a solid answer. Balanced. I love it. Well, thanks a lot for your time. Really appreciate it.
It's been fun.
How can folks get in touch with you if they want to reach out?
If you want to get a hold of me, MagnottaTeam.com is probably the best spot. It has all my information on there, and get everything you need from that, MagnottaTeam.com.
Awesome. We'll link to that in the information below, and I have had several clients work with Chris. He does a great job, always smooth closings, and they've been happy with the rates and the products, so thank you for that.
Thank you.
And really appreciate your time.
Awesome. It's been a pleasure.
All right, thanks. It was a great conversation with Chris. As we covered mortgage rates, they are a complex and fascinating topic, and as Chris explained, they don't move in lockstep with Fed policy and Fed moves. They're shaped by a mix of economic and market dynamics. With the September rate cut and potentially 2 more rate cuts already priced into the markets and mortgage rates, Sounds like rates are likely to hold steady in the low to mid 6% range. Many believe that once we dip below 6%, we're going to see a major influx in buyer activity. I agree with that sentiment. If you want to keep a pulse on where rates are headed, the 10-year Treasury yield is the key benchmark to watch. Looking further ahead, we'll also be watching a major transition when a new Fed chair steps in to succeed Jerome Powell in May of 2026. We'll continue tracking these shifts and changes right here on the podcast. In the meantime, if you'd like to connect with Chris, please find his contact information linked below. And as always, if you or someone you know is interested in Steamboat Real Estate, feel free to reach out. My email is ryan.cox@steamboatsir.com. I hope you get out, hike, bike, and enjoy these fall colors. Now we'll dive into a quick market snapshot. Diving into the numbers, median price per square foot in Steamboat is $806 a square foot. That's down 2% year over year. Median sales price in Steamboat is $1.24 million. That's $1.24 million across all product categories. That's down 4% from 2024. Median days on market for Steamboat is 24 days on market. Last month we were at 22 days, so that's crept up 2 days, and that is up 50% from 2024. In Routt County, the number of listings sold year to date is 417 listings. That's down 3% from 2024. In Routt County, our total sales volume is 681 million. That's down 4% from 2024. And pending listings in all of Routt County, current pending listings are 127. That's up 17% from 2024. And active residential listings as of October 1st, we have 385 active listings in Routt County. That's up 56% from 2024. Looking at some other data from Land Title, of the total transactions in August, 54% involved local buyers, 16% came from Front Range, 30% were out-of-state buyers. There were no international buyers in the month of August. There were a total of 117 loans in August, and 46% of buyers closed with financing, 54% of buyers closed with all cash. There were 64 loans refinanced in the month of August. Looking at interest rates, the 30-year fixed dipped to a low on September 16th. We dipped down to 6.13%. That's the blue arrow here. And the Fed announced a quarter-point reduction on September 17th, the next day, and you can see the rate bounced back up. As of October 8th, 30-year fixed rate sits at 6.3%. That's the black arrow here. The September jobs report has been delayed due to the federal government shutdown, so we'll see when we get new official jobs data. We continue to see signs of the labor market cooling. Private payrolls showed a job loss in September, and unemployment is holding around 4.3%. That's the same number we looked at last month. As we move into the fall selling season, we're seeing absorption tick up as there are fewer new listings, and some of the listings from summer go under contract. But the market is relatively balanced right now. Properties that are priced well and meeting the market are going pending, and some of the properties that have been on market for much of the summer have now seen price reductions such that they're getting picked up by buyers. We'll continue to track everything here. Reach out with any questions, ryan.cox@steamboatsir.com, and look forward to seeing you next time. Have a great day.